Well, hello, everybody. Michael Silva here. The big banks, if you haven't seen them, they are collapsing. They're selling off again. Actually, a lot of economically sensitive areas in the market actually have been selling off quite hard. And we're going to kind of walk through some of these charts from a shorter time frame, from a longer time frame, and then we're going to drill all the way down into some signal charts and the 15-minute time frame to get a little bit more tactical on today's Stock Market Brief show. If you're new here, welcome to the show. Be sure to hit that thumbs up. It is greatly appreciated. And subscribe to the channel if you haven't done so already. So we're going to start off here looking at the 10-year yield. This is crazy to me. I mean, this thing is just on a monster tear to the upside. We closed at 4.34% as it stands right now. And if you just look back, woohoo, to the left side of the screen, we're talking back into 2007. It's been a while since we've been this high. Doesn't mean, obviously, that we're going to have a financial crisis. It could mean that. But what this basically tells us is obviously there is increasing stress to the overall financial markets. And you can see this also here looking at like the 30-year fixed mortgage. I've been talking more about this recently because, well, I have yet to lock in my rate, and I'm about to move in like a month and a half. So this is just horrible timing. I'll be honest, though. Actually, I bought my house right here at this peak, my prior house at this peak right here, and I refinanced literally right there. So I'm going to be buying up here, and, you know, maybe it pushes up higher, but maybe I can finance back down in the 4 range, or, hey, you never know, maybe even lower. But we're talking, it closed at 7.09, which is, you know, really the highest. I mean, yeah, we can look right here, but if you look back to the left side of the screen, we haven't been here since the early 2000s, which is obviously going to force people really to stay in their current homes for whoever refied down here. But it's harder, and it puts more stress on people that are out there trying to buy a home as it stands. And if you take a look at the 10-year, 2-year yield curve, this thing is still inverted at 68 basis points. Remember, banks, they borrow short-term, they lend long-term, right? This is how, you know, this is, so when we have a yield curve that's inverted, the margins shrink, obviously, for banks. And it could put stress on banks. When you look at the 10-year 3-month, which is the Fed staple, right? The Fed curve staple. It used to be 10 and 2, and once we, you know, invert, you know, it predicts a potential future recession. But then it was like, okay, no, the 10-year 3-month is more important, and now that's not important apparently. But both of them have inverted, which gives us a good insight to saying, hey, there could be a recession potentially, you know, 10 months to a year and a half into the future. Now, as we see, they're currently trying to uninvert slightly here, and that's typically when you get a lot more stress on the overall markets too. I don't have that chart with me now, but I want to zoom in more to that 2-year, which is actually now back above 5%. So we're talking 5.02% where it's at. If you look back to the left of the screen, right, we haven't seen that since, once again, 2007. But if I zoom in closer and you see where we're at right here, we haven't actually been at this level since March, the early March, and that happened to be, guess what, when the banking crisis or SVB, Silicon Valley Bank, blew up, right? So this puts stress on financials. And you could see right here, right, it was moving up, and then as soon as it was right up here at 5%, we snapped. This thing from peak to trough dropped 47%. And now as we're moving back up here, what's the market doing? What are regional banks telling us? And I use KRE, but we can look at, obviously, when we zoom in, just on this small little run up right here, you can see that we've already fallen 13% on the KRE regional banks, so smaller banks. But if you look at the BKX, which is the KBW Bank Index, these are larger institutions. I believe this is like made up of the 24 largest institutions. I'm looking at a monthly chart here, and I call this level up here, this 120 area, the red zone. And the reason why is, for some reason, out of nowhere, I noticed that, hey, when we get up into this range, it's like something always happens. And I don't know why exactly, but you can see in 2007, we got up into the red zone. Boom. You know, collapsed right over there, all the way down to the 2009 low there. And then when we got up here, this is around the repo crisis, I believe it was. Don't quote me on that, but that was also matching up into this low where we had the a big break into the Christmas Eve massacre over here. It doesn't look big, but it was big. And then over here, we tried to get back up to the red zone, but that was the pandemic. And then guess what? The Fed stepped into the bazooka of money printing, and we shot up right through the red zone. But guess what? 2022 came, and we had a bear market. And then, obviously, we tried to come back up into it. And then, what was this right here? Well, that was the SVB banking crisis, and boom. Now, I am paying attention to this lower trend here, which you can see it is holding, but just take a look here with this small move there in the 2-year yield, with yield curves inverted, with obviously the 10-year yield that rose rapidly too. We're talking 11% down month to date. So there is something going on over here, and the reason why I'm pointing this out is really because it can all look very obvious in hindsight if something were to break. So this to me is telling us, hey, we need to be defensive. We need to be on guard here. Just be aware of what's taking place. Another thing to call out is Citigroup, right? Citigroup is a huge bank, a market cap of nearly $80 billion. This thing has now just cracked through the March, right? The whole banking crisis low. It just had a lower close. And, this isn't the only one, making a big hit down. I mean, this is the one that's really taken a big crack at the prior March lows, but you have things like Charles Schwab, Bank of America, Wells Fargo, all taking pretty gnarly hits, especially today. Now, remember, Fitch just recently warned that it may be forced to downgrade multiple banks, including JP Morgan. This was on the 15th, I believe, is when they came out and did that. And maybe perhaps the market is pricing in a potential downgrade. That could be because markets are discounting mechanisms. They're forward-looking. So that's a potential possibility. Remember that they just recently downgraded at the beginning of August the U.S. credit rating from AAA to AA+. That was on August 1st. And if we take a look at our month-to-date performance for, SPY, Q, IWM, Dow Jones Industrials, and then the 11 sectors that make up the S&P 500 plus some, what do you notice here? It's all red on the month of August taking place, except for a few bright spots in green. And what's green? The 10-year yield, up 9.32%. What's this little asset right over here? That's the dollar, up 2.2%. And then energy is barely hanging on right now. It's flat for the month, while everything else is sitting there in the red after this news drop. If I take a look at the monthly time frame on IWM, right, this is down 7.5%. This could very well be because regional banks and, energy is not really getting its foot off the ground. Like we saw a nice big run up. August, it's flatlined. But, you're talking energy names and regional banks. This is a big portion of the Russell 2000 small caps. But with rates going high, it puts pressure. And we just have not seen that big rally that we've seen like in the AI or the heavy mega market cap stocks. And this could very well be potentially a bear flag forming. Overall, we're in this nice, beautiful up channel since 2000 and basically 2000, and we had this exhaustion break during the financial crisis. During the pandemic, we had exhaustion break, and back when we were breaking through this, we were calling this an exhaustion break too. You'd have to go way back when, in 2021, when we were talking about that, or go to my Twitter timeline. But you can see now we potentially might be flagging. We're holding prior resistance. Prior resistance can become support, and notice the Bollinger Band is pointing down. This one's curling up. Remember, right? Things move between contraction and expansion. Then they contract, then they expand, then they contract, and then eventually at some point we're going to get another expansion, whether that means price comes back to the downside to test the lower trend, or we're going to break above that 200 and try to make a stronger move to the upside. If you take a look at something like the Dow Jones Global Index as well, look at where we bounced from. We bounced from the lower trend line over here. You can see since the 2008 financial crisis, since we recovered, we had this little low tail, this little low tail, this to low tail. We cracked through it with an exhaustion break. We were talking about it when we were getting outside of it here. And then we came back, we tested it, and we saw a nice big reflexive bounce. But this month, we're down 5.31% in the Dow Jones Global Index. And this potentially might be a flag, right? So we're seeing a nice, move to the downside. We saw a nice bounce. But what happens if the Bollinger Band comes here, this starts to go up, we're starting to contract, we start breaking back down from those levels? Well, that's a possibility as it stands. So we got to see and be patient. If you take a look over here at the dollar, this is a monthly time frame for the dollar. Remember, when the strong move happens in the dollar to the upside, it can put pressure on the market. So in 2022, when the bear market started, the dollar started ripping higher. And as we were moving at the end of 2022, where we found our top, that's, guess what, when the market started ripping. And now as it stands right here, we're kind of in this area where we had prior support. Support became resistance, 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 resistance. And we're kind of just right there in this consolidation. So if we start breaking through this, potentially, that sends us up higher in the dollar, which could be bad for the overall equities. Or we're coming down here and we might break back down and retest some the 100 level, or potentially try to take out this prior month's hammer candle, which we just crossed above the high. So this could be the start, obviously, of a bounce. Now, we already made it far with the dollar in a short period of time since middle of July, right? So we had this sell-off right over here. What's funny about this sell-off right over here, this was literally on everyone's timeline in FinTwit saying it was the end of the dollar. Like, it's over, things are breaking down, new bull market, all this stuff is great. And then literally within the same amount of time it took to fall, a little bit longer, we're above that level, right? So, and as this moved up, what happened? Well, the S&P 500 is now taking itself a brief correction, potentially, as it stands. Now, if the dollar wants to continue right upwards after this strong move, at some point it's going to have to consolidate or pull back. So we got to continue to watch that. But if the dollar wants to continue, to build up and break out further, that could very well put more pressure on the equity markets and other various assets. Now, despite gold being up on the day today, pretty nice move. So we had 2 small days of pulling back, and then we saw that move higher. And we technically started up gapping up today in the S&P 500, but we finished lower. Despite all that, gold was actually up slightly on the day, as it's still within this tightening wedge pattern. So if the dollar does want to take a breath, that might really lend hand to gold. But seeing today's correlation, it just tells us that, hey, perhaps there might be some sort of safety trade in the near future. We will see kind of how that pans out. Interesting ratio chart to look at on a weekly time frame or a monthly time frame is the copper to gold ratio. And this just tells us really quickly, hey, if copper, an economically sensitive metal, is outperforming gold, which is more of a safe haven. So this line goes up, things are typically going pretty well in the economy. But if it starts going down, meaning gold, right, big gold over here is outperforming Dr. Copper, it tells us that people might be potentially more focused on safety. And what's interesting about this chart, looking back 20 years or so, it matches up really perfectly to the ISM Purchasing Managers Index, the PMI. And what you'll see here is we are under 50. So you see this 1 hump, 2 hump, 3 hump. You look at the same time frame, 1 hump, 2 hump, 3 hump, right? And we're below that 50 level, which means that we are contracting. And there's a lot of different components of the ISM manufacturing index. And what was interesting when this came out in July was every single component, 100% of the components were actually under 50, means that we're in contractionary territory. So as far as manufacturing goes, it feels like a recession. So it seems like the service economy is potentially holding us up. But you can see, it's very rare that we get 100%. And each time that we did here, dating back to, 2000 or so, this is when recessions took place, as you can see outlined in the gray shaded areas. Now, if we take a look at copper to gold ratio on the monthly time frame, where we were looking at these 3 humps over here, and we just point back down to the S&P 500, you can see that when we have sharp declines where gold is outperforming copper or copper's underperforming gold, this is when obviously you could see the market potentially have some financial stresses. Over here, boom, we saw this big decline. And this was in 2011, bam, we saw that move to the downside. I know the Fed stepped in multiple times. Here we had quantitative easing 2, we had Operation Twist, we had all kinds of stuff. Even right here, you can see that this was heading down, and then we had multiple series of volatility bouts all throughout this area over here. And then as this started turning back around here, obviously when the bear market of 2022, and it's still currently pointing down at this time. So I would prefer to see copper obviously get a lot more stronger relative to gold, because that would be a lot more bullish scenario potentially for the overall economy as well. Now, if we go on to other economic sensitive areas, I've been paying attention to the airlines. So transports kind of shows you like, hey, are we moving? Like, how are airlines doing? Are people traveling and so forth? And I hear a lot of people say that travel's been very busy. A lot of the airlines are packed and so forth. And we saw this big, and that was during this big run up over here. I'm just using Jets ETF just for as a proxy, but we saw in June a huge move, right, from down here at around 18 to around 2250. But if you just take a look at individually at these airlines, that is a huge retracement in a short period of time for the airlines. Now, coming up this week, we have Nvidia on Wednesday after the close. That is what a lot of people are going to be focused on. This thing this thing can move a market for sure, which is crazy to me, being that it's a single stock. It's almost now nearly as important as watching the CPI reports are huge macro data points. It carries a lot of weight in the Qs, the S&P 500, and so forth, and really can lend weight to a lot of order flow. Now, if we move on, also on Friday, we have Fed Chair Powell speaking, which we don't know what he's going to say or if he's going to give us any insight to the future. He was quite reserved on giving us a forecast on the prior meeting. He said mainly it was going to be play it meeting by meeting and see how it goes. And we'll see here. I mean, he's coming on Friday, right? And Nvidia is here. So maybe whatever happens here might determine potentially, what he could be saying there, or, are the yields or rates doing necessarily what needs to be done, so he doesn't need to come in and strong arm the market. It's too hard to say, and it's just a lot of speculation. So we just need to really be cautious of that when he starts to talk, and obviously when Nvidia reports. Now, as it stands right now, Nvidia gapped up today to an all-time high, I believe it was, and reversed completely to the low of the day. So we opened at the high, closed at the low, bearish. They call this I believe a dark cloud coverage candle. But we still have a $51 expected move so far, 157% vol, right? The IV swells up going into earnings like a blowfish. So I like to pull this at the market, going into the market close to see where this is. So if we're like right down here, or right, say if we close, I don't know, we close at 450 tomorrow, just say. We close at 450 and there's a $50 expected move. That means as far as what the market is forward-looking risk for where the earnings might go, that can take us to 500, or that can take us back down to 400. But remember, this earnings right over here, we had also a pretty big expected move, but we blew through it. So it ended up being like a 3 standard deviation move. And if that's the case, I mean, we can see a $150 move, right? If we see something crazy like that happen again. So it's just something to be aware of, not something that I'm going to be putting too much money there at stake. I probably won't even be trading, to be quite honest. I won't be trading that product. Now, the semiconductors, we were talking about this trend line. Overall, right, semiconductors are in this bullish trend, so Nvidia is going to have a huge impact. It could potentially take us down to 140 or potentially up here to around the 160 marker, right? I believe it's around 20%, or the largest holding in SMH is Nvidia. Now, if we take a look at some trend and some signal charts over here, we are still, right, we discussed the potential bounce. That was a given. We saw a bounce. Where can it potentially go? Where we're calling around the 20-day moving average. But remember, the trend is still pretty bearish here. Looking at the 5, 10, 20 timer over here. This is you just using 5, 10, 20 EMAs on the Nasdaq composite. And we have the 5 below the 10, and that's below the 20, right? You want the 5 above the 10, above the 20 to be more bullish. So when it's like this, when they cross over, it lends hand to more bearish trend. If the S&P 500, if we take a look at that, we came into around the 10-period moving average and kind of rejected. Some dark cloud coverage there too as well. Right? We haven't seen a 2 days up in a row since really a few trading days ago over here, but then we followed through with 3 days to the downside. So the trend still remains bearish there. We have been quite oversold. If we look at the percent of stocks above the 200-day moving average, but we look at it through the lens of the Nasdaq, the NYSE, Nasdaq 100, the Dow Jones, S&P 100, S&P 1500, which includes mid-cap stocks, small-cap stocks, and then obviously the S&P 500. And you can see here, if we just take a look at the right of the chart, telling us that the S&P 500, there's only 15% of the stocks in the S&P 500 that are actually above the 20-period moving average. But remember, 500 plus 600 plus 400, that equals 1,500. So if we look at the S&P 1,500, look at here, 16% of the stocks, 16.5% of the stocks are above the 20-day moving average, right? Not too long ago, 80% of the stocks were above it. So obviously, a large, broad breadth movement to the downside. And sometimes when we get to these areas, they can be in oversold conditions. Crashes can happen in oversold conditions, but just be aware that the market may need to consolidate, to bounce, and so forth. And you look at Dow Jones, right? That's getting hit 13%. And that's probably that's the worst one on the screen. So the Dow Jones has been taking a nice big backseat here in recent trading days. If we take a look at the BP COPQ bullish percent index, you can see here we're sitting around 44%. That means that 44% of the stocks in the Nasdaq composite, and that's a huge index, 44% of them are on buy signals based off of point and figure charts, which are the tic-tac-toe looking charts. The RSI is an oversold condition. The NYSE bullish percent index is an oversold condition. The BPI NDU has just moved into oversold condition, but still 63% of the stocks remain on buy signals. And when you look at this, so I'm going to draw a straight line here. You can see we broke, right? We had a low, a higher low, a higher low, a higher low. We broke out, and now we might be just back testing the breakout. So if this was just a bear trap, that means we're going to probably potentially break down and continuing doing series of lower highs and lower lows, or we're going to find some strength and start to try to take out this prior swing high. If we take a look at bullish percent index for miners, this thing is getting cracked, right? Below 20%, so 17.86% are on buy signals, and the RSI is getting to oversold. This doesn't happen that frequently, and sometimes creates opportunities for more value investors that want to start adding to positions into miners. BPSPX chart is also in that oversold condition we talked about when it gets overbought, and then it goes to oversold. We said when it gets way up here, it's pretty extended to the upside, as we've pointed out prior. And then when it starts crossing down through that 70 marker, you can typically see some more weakness up ahead. I want you to go ahead and screenshot this photo over here. This is the daily expected moves. You have the upper level, the lower level, and the 2 sigma level moves for tomorrow on these products over here. So I'm just going to share those with you really quick, and then kind of just jump in to the 15-minute time frame. I've been beating this one up a little bit. We have the August low. It's still holding. If that cracks, that anchored VWAP, start to look at the lower daily expected move at 434. Today, we just closed within it, the daily expected moves. And we really have been unchanged so far for the week, right? We closed here, but we opened right here. And if I just draw this straight across, we're just slightly like right where we opened up on the week, and we're still below that declining 5-day moving average, right? We got above it. Oh, we got above it again. We're poking, and we're starting to potentially, as more time passes, right? This is, one trading day here, one trading day here, one trading. So that's 1, 2, 3, 4, 5. So that means we're going to lose this data, right? So this data is not going to count going into tomorrow, and we're going to start using this data going into tomorrow. So as if we can hold around these levels, if price can, get above and consolidate or so forth, this is going to start, as you can see, flattening itself out, which would be a positive sign if price can get above it, and then we could potentially move into a markup phase. Okay, but if price wants to break down and head lower, yeah, it might flatten out for a little bit, but it could still trend itself to the downside. If you take a look at the Qs are above the 5-day moving average now for a couple of days. So we have 1 trading day, 2, 3, 4, 5 trading days. We're going to be losing this data. So everything from this orange line forward into here is going to be counted. So as we lose this data, which would be great, this is going to start to flatten out further, and that'd be good if we can keep holding around these levels. So we want to hold the anchor VWAP from the August low, which would be positive, but if we break through that, look for the lower daily expected move to potentially get tagged. In the pre-market session, you can see we came up here. We were pretty much open there at the upper weekly, but actually in the pre-market right before open, we actually tagged the weekly expected move and the daily expected move, and basically the open was the high of the day as we reversed and closed near the lows of day. That's really all I got for you. If you want to stick around really quick and see some of the trade ideas that the scalp ideas that came with the new upgrade that I added to my Sing trading community, I'm going to go walk through those today. So I only charge $9 a month, and I would give a bunch of different stuff out, right? I have my trade ideas. I give watch lists, weekly, quarterly, monthly, daily expected moves, my zones, which is a pretty cool product there that gives a good overview of the overall markets being overbought and oversold, permalinks to stock market indicators and the community. But I recently just made this purchase to add in the Tradietics software, and this gives us query bots, so you can just type in a command in the query channel of my Discord. And by the way, this is not being positioned as a alert service by any means, but they do, Tradietics now offers the Strat Scalp bot, and I have included that in there. Okay, but yeah, you can type in all these commands and you can get really cool charts, including 0 DTE option data during intraday trading, and you can see, what expiration is potentially pulling, not expiration, sorry, what price on the options chain is potentially adding to or pulling at any time just by typing in a command. You can see 0 date levels. It's pretty cool, and there's so much. There's so many things that was added on, and then you have the auto posting bots. These are the ones, like for example the scalp bot. It's pretty dang cool. I've been playing around with the bullseye bot, keeping a close eye on this one too. This is more for options. Scalp bot does stock and option trades idea too as well. Then you got another one, Trading Flow, right there too. But they got I'll walk you through. Yesterday I walked through, it got 7 out of 8 right. Today it was mainly short trades, and you can see, like, I put the entry kind of where this came out. So this is what it looks like. And as you can see, the target was down here. The stop was way up here. So your risk is obviously a lot better than your reward. So you need to be aware of that. And, it says on the 1 day, so this is a strat based off a 1 day candle. So you can potentially swing trade this. But if you are just looking to scalp, you would have entered here, exited here at the end of the day if the target wasn't hit, I guess, wherever you choose. But that would have been an in-the-money trade there on Oxy. JNJ, the enter was here. It did tag the target, so that was a winning trade there. Amgen was an entry here to short down to here. That was a winning trade. LRCX entry here to short down to here. That was a winning trade. ZM was an entry here. It didn't hit the target. It didn't hit the stop. So if you got out of the position over here, let's just say end of day, it would have been a winning trade there. BX was an entry here to a potential target down here. This and then a stop up here. So this looked like it could be a potential swing trade. I know I'm looking at it at the 5-minute candle, but it was based off of the 1 day, the strat on a 1 day candle. But you can see we actually closed a little bit higher. So if you exited at the end of the day, you lost 6 cents per share on this one. Netflix, it was the only long signal we bought here. It came down a little bit, but the target was actually hit before the stop loss, so that was a winning trade. Baidu was another short stop. It was a short position here. The entry was right here. The stop was here. The target was here, so it didn't hit. So if you exited end of day, you would have been in the money, 50 cents or so. CPE, which is another one that didn't do anything. You can see, could be a potentially swing trade here. But it was a short entry to come down to a 35.54 entry here. It closed up 4 cents. So if you exited end of day, that was a 4 cent per share loss. And then this one, AVGO, this was a quick hit scalp trade where the entry was right here and the target was right here. So this was like a boom, done in 10 minutes. And then you can see it ripped to the upside. So that's why you got to be fairly quick on some of these trades. But you could see here, like, okay, well, the risk was right all the way up here. The reward was a lot smaller. So you do need a higher hit rate on these type of trades. Not all of them have a huge risk like this to a small reward, but it's something to pay attention to. So once again, thanks to all my partners there at Patreon, or all my Patreons that support me. Then also I have work with Interactive Brokers, they're an excellent brokerage firm, and they help this channel out. And then also Bookmap 2, which allows you to see behind the candlesticks. You can get up to 50% off on the quarterly or yearly subscriptions, and then they offer a discount code to my subscribers for up to 20% off. I will call out here on ES, there are a couple levels to potentially pay attention to, which is right at around 42.90 and then 45.87. There's about 500 contracts up in these hidden areas. I don't know if that's going to come into play tomorrow necessarily, but you never know. With Nvidia reporting after the bell, markets might be looking to come into one of these levels. Other than that, you have your daily expected moves there, which you probably already screenshotted if you didn't right here. That's all I got for on today's episode, everybody. See you later.